We moving into session 5 of the program. So it's a pleasure for the Global Innovation Hub to host this session. It's the actually second time that we are having the privilege to talk to the multilateral development banks. These are, as you could hear today, very key players in the implementation, time for implementation of the Paris Agreement, and key players in the climate agenda. So we are very privileged to have them all here. And the Global Innovation Hub is promoting innovations that are transformative, that are integrated, that go beyond technologies, but also look into financial instruments, innovations in terms of financial instruments, business models, and new cultural changes that will help us to implement transformative innovation. So we will be very lucky to listen from you, where you're up to speed, and where are you going, and how do you want to get there. So with that said, again, thank you very much on behalf of the Global Innovation Hub, and I would like to pass to our moderator. She will be guiding us through the session today from KPMG. Please, you have the floor. And you need a mic. There will be another mic coming shortly.
Great.
Thank you.
Thank you. Thank you for the introduction, and we're very happy to be here today. My name is Tracy Lane. I'm with KPMG East Africa. I'm based in Nairobi, Kenya, and I lead our climate change and renewable energy and ESG portfolios in the region. We have a very distinguished panel here today with the real experts around climate finance in Africa. And I think we're here to talk today about transformative innovation, what kinds of financial instruments, how can we mobilize capital within Africa for Africa to address climate challenge in Africa. So I'd like to start and just jump right into our questions today. I'd like to give the panelists a chance to speak from their view, their perspective around the challenges that we're facing within the financial sector in mobilizing capital. And then what are the solutions that are available? What could the solutions be? Do they exist today or do they not exist today? Do we need to develop new solutions? And then what can the institutions gathered here today help to do to contribute to the solutions? And what other partnerships might we need, and what other inputs might we need to really transform the system? So I'll start with just a very brief introduction of who's up on the panel, but I'll ask, of course, my panelists to introduce themselves in more detail when you get the mic. So we have Helen Brume, who's the Director of Projects and Asset-Based Finance from the African Export-Import Bank. We have Alain Tchibozo, the Chief Economist from the West African Development Bank, based in Lomé. We have Anthony Mukulu, the Company Secretary from Rwanda Finance Limited, based in Kigali. We have Andrew Asira, Head of Operations for the East African Development Bank, based in Kampala. And we have Fanglu Wang, the Managing Partner of ESG for CITIC Capital. Welcome, everyone. So let's start with the challenges. Let's set the scene of what are our challenges. If I may start with you, Andrew, what would you say, from your perspective, are the challenges in financing transformative climate and sustainability solutions in Africa? Andrew. And Andrew, if you could just give us a brief introduction of EADB while you have the mic as well, and kind of your role. Yep.
Thank you. East African Development Bank is a regional DFI that supports projects in East Africa by providing medium and long-term finance. Medium long-term finance, we're talking about the range of 5 to 12 years. Now, the bank was established with the mandate to promote socioeconomic development in that region, and we're talking about Uganda, Kenya, Rwanda, and Tanzania. Recently, Burundi and DRC joined the East African community, and therefore they will soon subscribe and become members that are supported by the bank. Now, in promoting socioeconomic development in the region by way of providing long-term finance, the key challenges that we face, one, is the cost of finance. The second one is the currency. The currency. Remember that when you are financing projects, there will be those that do not generate foreign currency from export. How do they service debt that is denominated in foreign currency? So there is a big problem when it comes to being able to source for local currency, because we come from a region where the capital markets are not deep. So if you're talking about projects that require financing for 10, 12 years in local currency, then you do have a problem. If you're going to finance those projects in foreign currency, then you have a huge currency risk, and especially if you're talking about social projects. Now, the other challenge that we face as a region is the, how do I put it? How do you put together these projects? Advisory costs are high, consultancy costs are high, but how do you package these projects into becoming bankable? And then on the other side of it is, how do you make sure that the DFIs have the capacity to be able to appraise these projects? One very small point that you may need to think about is that it costs the same amount of money to put together a $1 million project as it would to put together a $100 million project. So when you have these small projects, how do you support them from a technical assistance perspective? I think I don't want to exhaust all the challenges. I'll leave that to my fellow panelists to exhaust a little more. Thank you.
Okay, thank you very much, Andrew. Let's take maybe a West African perspective. Alain, would you be able to tell us from your perspective what are some of the challenges that Africa is facing?
Sure, thank you, Tracy, and good afternoon, everyone. I am. Hello.
Yeah, we can hear you.
The chief economist of the West African Development Bank. And the West African Development Bank operates on 8 countries. West Africa, all 8 countries sharing together the same currency, the CITIC franc. Our job is to provide financing, mainly long-term financing, to support projects. I would say that 2/3 of our projects are public, so we lend to governments for projects, and the rest is for private. Our size is roughly $5 billion US, the total assets. The maturity of our book is roughly 12 years. And what is the key challenge we have? I would say that every single year, the key challenge from our perspective is to see the increasing imbalance between the demand of financing of new projects and our capabilities. We have capabilities which do not grow as fast as the demand, and climate-related issues are making things even more acute today.
Thank you. So that's 2 perspectives from the regional development banks. Let's move to the African Exim Bank. Helen, what would you say from your perspective and from your institution's perspective are the challenges in financing climate solutions?
Thank you. My name is Helen. Okay. So my name is Helen Brume. I'm the Director for Project and Asset-Based Finance at African Export-Import Bank. We're primarily a trade bank, but we recognize that to fulfill the auspices of our charter, we need to invest in developing trade-enabling infrastructure, which is where project finance comes into play. We have 54 member countries, and just working across those countries, I would say that there are a few recurring issues that we constantly see. One of them is the absence of a lot of sponsors to have a basic understanding of how to identify projects that are bankable, and even helping those projects get to a stage where they can actually approach financial institutions for funding. And I think this is where, development banks like Afrexim Bank have tried to play a strong role by creating a project preparation department, which helps sponsors with funds to enable them develop their projects. Those funds can be used for feasibility studies, pre-assessment studies, front-end engineering design, even advisory fees. And the idea is that the money is recouped when the funds when the transaction reaches financial close. Another issue that I would say is also prevalent is the fact that when you look at your typical sustainable finance transaction, it is possible that at the point you're approaching financial institutions for lending, you may not be able to demonstrate bankability simply because of the nature of the project. The project might be a project that needs time to scale up, that needs the investment of probably patient equity or private equity, which may not be available, especially on the continent at that time. When you look at projects, not every project fits into your typical project finance structure of a debt to equity ratio of 70-30. And even speaking about equity, if you're trying to fund, for example, a $300 million project and you're asking for 30% equity, 30% of 300 million is a lot of money. It's a lot of money, not just for an African-led initiative, but even just globally. And there are not a lot of institutions that support sponsors with the kind of equity they're looking for at that time, which is patient equity, equity that will wait and not be demandful of returns at an early stage. We at Afrexim Bank, obviously recognizing the shortfall, 2 years ago set up a subsidiary which is expected to try and invest from an equity perspective. They can also do mezzanine debt. They can also do private equity funding, up to $25 million per project. It's called Funds for Export Development Africa, and it's a subsidiary of Afrexim Bank. And so these are just two broad issues, and then I also talked about some of the responses that Afrexim Bank is taking to address those issues as we recognize them to be prevalent on the continent. Thank you.
Thank you, Helen. You've highlighted some of the issues that I'm hearing in a lot of the discussions today on Finance Day here at COP. And you've moved us into the next topic of solutions. So thank you for that. That's what we're really here to talk about. It's not just the challenges, but the solutions. And I think that's where our task today and over the next few years is really what it's really all about. So if I may, Anthony, ask you about financial instruments or other types of solutions from your perspective. What kinds of financial instruments do we need? What do we have and what do we need? What could be developed to address some of these challenges?
Thank you, and good afternoon to everyone. I'm Anthony Mukula, as they introduced, the Chief Legal Officer at Rwanda Finance. Rwanda Finance is the agency mandated to develop and promote Kigali International Financial Center. Now, from my experience, and today being a day for finance, we're also talking about sustainable finance. If you look at the ecosystem in most of the countries in Africa, you find that some of these aspects of sustainability, you talk about sustainable finance, you talk about upscaling finance, these are new concepts. Now, when you look at them as new concepts, you come with the challenges that my colleagues alluded to. Now, what are some of the solutions? One is that there is need to have broad sensitization with all stakeholders involved, because if you look at, for example, sustainable finance, You'll talk about the green lending. You'll also talk about the skills within the ecosystem that is required to run the sustainability that you're talking about. So here there is need to have more private equity injection because most of the projects are run through public finance, and that is not sustainable. So this is an area that we need to have both public and private initiative, but also focus more on blended finance because that's the future and where we are going. So in a nutshell, there is need to have more private equity injection to ensure that some of the challenges that we're discussing today, we can achieve them and put them aside faster than relying on public financing. Thank you.
Okay, thank you for that. If I may ask a follow-up question then on that, and because we've heard this now twice, we need more private equity, we need patient equity. How do we achieve that? What's stopping that from happening now, and how might we get that injection of private equity capital? Any volunteers for that question?
The question of the equity is, you're totally right, is the key question. Why? You need to understand where we're coming from. We're coming from financing development with grants. These pockets are empty now, are getting less and less grants are available. Meaning that if you don't have grants, you need to have a funding, and the natural funding is to go to take a loan. But when you take a loan, if someone lends you money, there is no way he would expect you not to repay. But if you use the money in a project that fails, there is a loss. So the question of the equity is, whenever there is a project, who is going to take the first loss? And this first loss is what we all call equity, right? So to find a loan, to go and borrow for money, senior debt, it doesn't work either, yeah? Much better, oh yeah, thank you. So I was saying, someone today who has a strong rating, he can guarantee that he will repay, will find much easier to find funding for projects. So the question is, those who do not have rating, those who do not have a good reputation, do not have access. And usually, this is the case of all our SMEs. This is the case of all all SMEs in Africa. They just don't have enough reputation. So to offset this, they are asked to put collaterals, guarantees, and equities. And you were saying that someone would ask you to put 30% in equity for a project, and you were 30% is too much. They don't have it. So how to do it? I think the way we do it in West Africa Development Bank is to try to separate the things. So we do on the project that we identify the part of risk and the part which is not risky. And the part of risk, we try to find what you call blend, which is either insurers or supporters who are ready to support the project, because they say even if these guys lose money, at least they know that what they are doing is they're going to get impact. So what I can say today is that there are counterparties, there are investors, there are supports, there are foundations who, in exchange of impact, are ready to lose money. And these are these guys who will provide the equities. Of course, these guys will be demanding. They are ready to lose money, but no way they will go to a project where they are sure to lose money. So it's different. So we need to be disciplined. We need to work on the projects to make sure the project is bankable. And of course, even good projects, a percentage of good projects can go wrong. And this is where you need equity. So we have many technicalities. You have, I mentioned, insurance. You can insure. You can securitize. Of course, you can just put equity if you are rich enough to. But there is even one thing that we tried. It's what we call quasi-equity, which is not equity. It is light equity. It looks like equity because it is structured as a very long maturity loan with very low coupon. And in case something goes wrong, you stop paying the debt on this. So you stop paying the coupon. So it is like an equity able to absorb some losses, but it is not equity. Why? Because after 40 years, 60 years, you will repay. So you see? And this is a way to find money, to find funding by lowering the cost of funding. So if I were to summarize, I would say for a project, what you need senior debt, and as long as you can guarantee that you will repay, it's okay. Of course, you pay your coupon, but it's okay. And then you have the equity part. And this is where it is tricky. And even of this, we can find some technicalities. So our take is that usually people would say there is a funding gap. It is impossible to finance development in Africa. We won't say that. We need to be clever, but we can do it. Sorry, I've been too long.
No, that was great. What you've done there is exactly what we're asking for. What new instruments have been developed by your institution to try to address this problem? And it sounds like the quasi-equity approach is one that you're testing maybe now, early stages. Okay, well, we'll come back and ask about that in a few years. Or maybe your colleagues can build on that idea. If I may now go move to Fanglu Wang. Now you're newer to Africa, but you've been operating in Asia for over a decade. Perhaps you could tell us a little bit more from the context of Asia and how you're hoping to bring some of those lessons and experiences and innovations from Asia into Africa as you begin operations here.
Hello. Yeah, thank you, Tracy. Thank you, Musungu, again, for getting me on this wonderful panel. My name is Fanglu Wang. I'm managing partner of the ESG group with CITIC Capital, which is based in Hong Kong, a major alternative investment management firm established in 2002. Our sustainability-related investment theme started actually 12 years ago. That was much earlier than our peers. So we have seen a lot from Asia. What we have done since the starting point of our strategy has been, I think, based on two success factors. The first being finding the most suitable and the best technologies and products worldwide in the field of energy efficiency, clean technology, renewables, food and water technology, and modern infrastructure and the logistics. But then we don't stop there. Our other and probably a more important success factor is to find broad applicability across different growth markets in Asia, where what we know the best. Therefore, our value added is very much on how we helped the technologies developed and proven in other markets to scale up in Asia, especially in the markets that we know very well, including China and the other Asian markets. So we have done this for 12 years. We have learned a lot. And the reason I'm here is that I'll be very happy to share the lessons we learned, the experiences with the colleagues here. And I think the success and the failure in Asia can be shared across different geographic regions. So in terms of a challenge, I think enough has been said. about all these factors, I don't think Asia is different from other, let's say, growth markets in these sort of risk factors. But I would like to point out from a private equity provider, the most important consideration, and on top of all these currency, regulatory, whatever, right? I think the bedrock of our investment success is the cost effectiveness of the technology and the products. So no matter how good the technology may sound like, for the longer term, for it to success in one market or multiple, it has to provide the right cost effectiveness. Otherwise, I don't think there is enough so-called patient capital just to support it for too much longer. And as an investment sort of management professional firm, our biggest challenge from, let's say, to our side is actually how to find these technologies and how to make them successful in the markets that we know the best. So the challenge for us, that is to say that we need to have a very broad network and collaboration with various capital providers. So throughout our investment experience, we have worked very closely with the DFIs in our markets, such as Asia Development Bank, IFC under the World Bank, EBRD, right? So I think these banks' mandates are not dissimilar with yours. So I think there have been a lot of collaboration that can show that the private sector and DFIs and public finance can work together. But I want to say that every successful case is not a textbook case. In fact, the textbooks are written based on these success cases. So that means that we need experience, we need insight, we need open-mindedness to approach each challenge. I'm happy to say that I've been introduced to this forum by my dear friend Thomas Wu, who has shared with me a lot of his insights and experiences, not only from Europe but also from his deep experience in Africa. So I have benefited a lot from this. So for us, it's very clear. Different types of capitals are available, but how to form the right consortium of capital that addresses each capital provider's needs and also the customer's needs. That is the key. So as a professional, we are very, very careful about one thing, that is credibility. Because on the positive side, one success leads to the next. But on the other side, that is one failure basically closes the door on us. So that's why we're very careful in terms of selecting the right opportunity, the right market, with the right partners. Thank you.
So the right projects with the right partners in the right places. And I think that's a useful lesson. I think I want to pick up on something else you said in your remarks, Fanglu, that we're not dealing with textbook cases here. And I think what that says to me, and with the challenges you've raised, and I think what we're highlighting is that the challenges are somewhat specific to the African context. So maybe we need a new textbook. That's what I have to say. That's my takeaway there. But what would we put in that textbook? What else can we do? What new things might we be able to develop? Or what new partnerships can we bring together to build out this new textbook that we need for financing climate solutions in Africa? Helen, if I can ask for your thoughts on that.
Okay, I'll take a stab at this. So, I mean, when we talk about raising equity, and any amount of equity, it requires a certain level of sophistication, right? I mean, you're talking to someone about a project, and you are trying to convince that person to defer their returns because obviously the equity holders have to wait until whatever debt is repaid. It requires a certain level of sophistication, as I said, and we find that missing in a lot of African sponsors. And I think that's where, capacity building and technical support comes into play. And I think that's where, organizations such as mine, DFIs, could do a lot more in scaling up the savviness of the borrower who is trying to access not just equity, but also debt. And secondly, I think as sponsors, African sponsors particularly, you need a certain level of flexibility in the capital structure. We find that a lot of sponsors are reluctant to give up significant portions of their equity. I mean, if you talk to an African sponsors and if they had an opportunity to leverage the entire transaction, 100% debt, they'd be more than happy to do that. But that capital structure is not optimal, right? So you need that flexibility, and like my co-panelist said, in considering different types of asset classes, whether, what is the maximum number optimal debt? Should you bring in stream financing? Should you bring in mezzanine financing? So I think that's flexibility, and I think, it goes hand in hand with the understanding, or from the sponsor's perspective, on how these different asset classes work and how it makes their project more attractive to whoever wanted to put money into it.
Thank you, Helen. Andrew, may I ask if you have some remarks on that, in terms of what would we put in our textbook on the new textbook that we need for financing climate solutions in Africa?
I think I first started by talking about cost being a challenge. And I do not think that we have control over the cost of private capital. For us to be able to crack this issue of financing climate action, we have to think differently. We have no control over private capital cost. We need to engage governments to set aside capital for these projects. That's my view. Then we can control cost. Now, that then brings me to the other issue that I talked about, which is how do we then get local currency to be able to address the currency risk that is going to come from a number of these projects. Once you have the cost of the underlying credit line very low, then you can engage houses or institutions that are able to handle market risk through cross-currency swaps. The swaps increase the cost of the funding, but at least you've managed to handle the base. The cost of the currency swap will be loaded onto it, but it's still a better priced product. Now, then the other issue is who carries the market risk from cross-currency swaps? That is where we need partnerships. That's where we need, again, governments to step in and say, in the event that you had this sort of market swings, this is how we'll get in to backstop the risk. And there's something else. What happens when the project fails? What happens when the project fails? Because projects fail. If you are a DFI and you funded a project under climate action and it doesn't work, what happens to you? I think we need to start thinking about risk-enhancing mechanisms from a credit perspective that protect the institutions that are funding these projects. Unless we address these issues, there will be projects, but there will be no funding for these projects. That's my take.
Alain, may I ask you to contribute?
Yes, fully agree. Fully agree. We are back to the story of the risk, and the risk is key. Risk is critical. And from this perspective, what we can say is that there are techniques to manage the risk. there is one thing I never understood, and that's several years I've been working on that. It's what they call the risk premium. When we build a project of, to make it simple, a solar plant, and I go to see any bank. If the solar plant with exactly the same plans and everything is based in Europe, I would get 3-4% interest rate charged. If on the same project, I just change the country and I say, this is in Africa, I go to 8 or 9%, and they call it the risk premium. And they would say just because Africa is risky. And I would say, how do you know? Have you ever been there? No. So you see, managing the risk, I agree with you, but we have hard work to do. Do you agree?
So it's not just the actual risk, it's the perception of the risk, okay? A big challenge, I think, and I think you've touched on it a little bit. How do you know, and how do we get people to know otherwise? What's the solution there? What might we bring to the table? I think, some of this is around partnerships, and we've already discussed that to some extent here. What else can we do to change that perception among the people who haven't invested in Africa or who are less comfortable? It's the perception is the problem for them, but it's causing a problem internally. How do we change that perception? What's any contributions on that question? I know that's a challenging one. How do we change that perception?
Thank you. So for me, I can put it that we are aware that Africa is the fastest growing economy. And when you look at that, we have also seen the strides that have been achieved under the African Continental Free Trade Area. So when you look at all this that is happening, vis-a-vis the perception, the decision makers should think twice. Because when you look at the other pros for investing in the continent and you lag behind, it's a decision that in future you look back and say, I got it wrong. So perceptions happen, but they are overriding developments that I've mentioned that I wouldn't say would stop someone to invest, but take it a step at a time and then see what you reap, but don't fail to invest. So I just wanted to echo the pros and where the continent is going. That should really water down the fears to invest in Africa. Thank you.
So countering that perception of risk with the opportunity that's available, yeah? Andrew?
If you allow me, I just need to mention that the issue of country risk is not a matter of perception. It's real. It's a science. I think that is supposed to be the beginning point for Africa to appreciate that the issue of country risk is not a matter of perception, it's real. There's a science in arriving at country risk. What we need to be thinking about is how do we mitigate the risk? Because that's never go away. That's not going to go away. Our discussion should be around, yes, this particular country has this type of risk rating. How do we support through mitigation of that risk so that that country can access cheaper capital for purposes of supporting climate action? I think if we take that approach, we will be successful. If we do not, then increasingly what we are calling perception is not really perception in the other world. It's in the world of funders. It's actually real, and we won't be able to attract the capital. That's my take.
So some differing views on the panel here. Maybe it's a little bit of both, perhaps, perception and reality altogether. Fanglu, you, as an outsider coming in, maybe you could talk about risk perceptions and the risks, the reality as you see it, as a new entrant to the market, and how you factor that in as you've come into the market, the risk situation and perceptions.
Hello. Yeah. Yes, we started about 12 years ago in the Asian markets. So we faced, at that time we faced all these questions, but then what we did was to do our best to address all the risks and mitigate them. We understood at the time we could not eliminate all the risks, but then we still had to do our best to mitigate all these risks so that in the final analysis, then the risk, the overall risk profile became acceptable for us being an investment manager, but we have our fiduciary duty to our investors. So no, that is the role of a professional investment manager. So yes, I understood from the Asian market, then the risk premium, the perception of the risk was there 12 years ago and it is there now. That means it takes time to change the perception, but we cannot wait. So in the meantime, we still did multiple investments in the Asian markets, which means that we were trying to find, again, the technologies and products anywhere in the world. Actually, very often, because in the ESG space or sustainability, the developed economies were ahead. So therefore, we tend to find some very interesting technologies and products proven in the home markets. So that that actually helped to lower the barrier. So what we had to do was to find the applicability in the markets that we have. So then we were actively trying to de-risk the opportunities just to make them palatable to the investors facing our markets, right? So very importantly, I think the success, again, it was based on finding the technologies with very high level of IP that could generate very healthy margin by themselves and be less dependent or sometimes actually independent of the government support. So that was actually the value we add to our investors and also collaborate the other capital partners by finding these technologies. For example, one of our investments was in the waste to energy space. This is a very unique technology developed first in New Zealand to develop certain types of bacteria to capture the carbon content from industrial waste gas, from the steel mills, refineries, whatever, right? So the technology itself was very unique. The demo actually was done first in Asia, not in the developed market, because the company actually did the right thing. That is, they understood the acute demand from the developing economies might give them a faster path to commercial success. So they actually selected the emerging markets in Asia to commercialize their technology first, rather than the other way around. Let's say the traditional path was to prove yourself in Europe, North America, Asia, Latin America, Africa. No, that was the original sequence. But then they actually turned it around. So their first commercial line, two commercial lines, were actually first in Asia, China and India. So then they developed their other markets in Japan, North America, and Europe. So for us, it was very satisfying to be able to find such technologies that, first of all, could address a very important demand across different markets, and also to produce value based on its IP. Then everything became easier. And I wouldn't say that all the risks could be removed, but then it at least helped us in terms of reaching the investment decision.
No, thanks for that. I think we're talking about innovation and financial innovation, but that brings us back also to the technological innovation and looking in the right places and being open-minded to the right solutions for the problems that you're trying to address, the climate solutions for the climate problems in Africa. So if I may open it up, we have time for just a few questions. I think the gentleman over here in the corner would like to ask a question. Please pose it to our panel.
I just quickly wanted to fix the problem about perception change. Because perception change is nothing else than spaghetti bolognese. If you know what ingredients you need, you are able to do spaghetti bolognese in a way that the whole world is accepting spaghetti bolognese. And it's the same with perception change. So it starts with, if you are not visible, nobody trusts you. So you don't see me, so basically I don't exist. The only thing what is existing when you see and read texts about Africa are the horror stories on whatever you know I don't need to tell you. So basically it's a question of maths. Count the amount of text published in Wall Street Journal in the FT and then try to find out how many reports are on Africa. And as long as this is not above 1.5% of all the texts in Wall Street Journal and FT, don't cry about your bad reputation or your bad perception, because it's you who are either offering the stories to the FT in the Wall Street Journal or nobody else. We did this for South Africa, we did this for Allianz. You can even insure yourself against media damage, and Allianz runs the insurance. This is how scientifically proof it is. But since 30 years we have a history that especially the finance sector says, oh, perception, you know, that's done by somebody else. And it's not us. But at the end of the day, just talk to the top management of Allianz Insurance. They are offering this product only because they learned it the hard way. Remember Holocaust? Who wanted to do continuing business with Allianz after the media were taking big stories on how Allianz was involved in Holocaust? Remember Dresdner Bank and the disaster? So speak with your Allianz guys around the corner, try to find out their portion of spaghetti bolognese, and perception change should no longer be a topic when we meet next year in Dubai.
Sure.
I think since we are doing very large projects in Africa, I think three main risks always. Can you hear me now? Ah, fantastic. So since we are doing quite large projects in Africa, there are always three group of risks. One is the technical risk, one is the customer risk, and then is the country risk. From a technical risk, I can only recommend what Mr. Wang says, go for proven technology. And if it's really proven, you can even insure the technical risk. Yeah. So in all our technologies DSE is using, we are using Munich Re to give performance guarantee for the product. When we set up a solar park, when we set up concentrated solar power, when we set up green hydrogen plants, all the performance of the technology is reinsured by Munich Re. So it's much easier for the banks to finance it because they can mitigate that risk. When it comes to our customers, we have always the right mix between export and import, and export or local markets, so that we have a certain percentage of off-takers from AAA customers, so it's really clear, okay, we're going to sell our green hydrogen properly over the next decades. And then when it comes to the country risk, and maybe our colleague from African Exim can tell us more about this, because we were very happy about this, is the country guarantee. Yeah, so African Exim Bank, and we are negotiating now again. You know, I think this is a fantastic facility to mitigate the risk for the country, the guarantee of African Exim Bank when it comes to country risk.
Thank you for that. Helen, may I hand the mic to you?
I didn't hear what he said. What did he say? I couldn't hear him. Okay. I don't know much about that.
Okay, we'll come back to that in another discussion. May I ask, are there any other questions from the floor? Please.
Thank you. No, just a quick question on my end. In terms of green projects, I believe on the continent we have issue about pipeline development. So, and I didn't hear that in your respective intervention. So what are you doing to tackle that issue, even before giving those products? What are your respective institutions, maybe one or two, in terms of like developing project, green project, sustainable project, specifically for those targeted areas?
Okay, so making sure we have a full pipeline of projects that are going to actually address the climate challenge.
Thank you. I'm not sure you will be happy with what I'm going to say. But yes, 18 months ago we did issue an ESG bond. This is true. But to be fair, it was more related to the S, social, than green or environment. In our countries, the reality is that social is an issue. Demographic is strong. You have a lot of people migrating to the cities. The cities are not ready to accommodate them. You need to build affordable houses. You need to feed people. You need to provide hospitals, schools. So all 90% of our ESG actions are S, are social. Sorry. We have 10% with the rest. So we have, but small. Why? Why 10? Well, because at the stage where we are, you know, we're talking in our countries, the GDP per capita is 1,300 US per annum. So we need to manage priorities, you see? So before talking green, we need to feed people. Otherwise, with TV, they would not admit not to be fed. So then we're gonna be in trouble.
Okay, so I know we're running out of time. I'll wrap up. I'll just make a quick comment on that. In terms of the S, there's a great need, yes, to address the S, but I think it's important to make sure we put the E together with the S because those are linked as well. So that time will come. Good. So we've run out of time. Unfortunately, I'm sure the panelists would like to continue this conversation, but we've run out of time. So I want to thank you all today for your time. We've talked about what the challenges as we see them are, what some of the opportunities and instruments that we've put in place. We've heard about what new things we can do around capacity building, around risk perceptions, and we've also talked a little bit about coming back to basics and really structuring the looking at every single risk and how do you one by one address each and every one of those and put all of that together and package that to really bring about an upscaling of the climate finance that we need to address Africa's challenges, climate challenges. So thank you very much to our panelists, thank you to our audience, and we look forward to continuing this conversation.